Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is Tuesday, September 19th. This is host Richard Bernoulli. We have return guests today, Professor Michael Pettis, Louis-Vincent Gabe, and Ira Harris. Michael is Professor of Finance at Peking University, based in Beijing, China. Louis co-founded Gavekal in 1999 with his father, Charles, and Anatoly Kaletsky. Before co-founding Gavekal, Louis worked for Paribas Capital Markets, where he was an equity research analyst from 1997 to 1999. He studied economics, history, and Chinese at Duke University and Nanjing University. And Ira's hedge fund manager, global trader in foreign currencies, commodities, bonds, equities for over 40 years. He served as CME director from 1997 to 2003, and a stint also most recently. Welcome, gentlemen.
Thank you.
Thank you. Thanks for having us.
Great. I thought we'd delve right into issues, what's happening in China. Professor Pettis, if you'd like to bring us up to speed, you mentioned you just began the school year, and what is the sentiment like there in China?
Yeah, as I mentioned, school for me started last week, and in talking to my students, one of the things that occurred to me is that I've never seen this level of nervousness about the future or of anxiety. Now, I don't know if it's to do with the economy or if it's to do with many of these students have spent most of their college life, in the COVID period, which was probably a very unpleasant way to go to university. But at any rate, it was striking, the difference in attitude.
Interesting. And how do you see the economy in China with the challenges of like the real estate property markets going on currently?
Well, in the short term, I think the second half of the year will be much better than the first half. I think there was a lot of, pretty typical in the press, a lot of excessive doom and gloom. But over the longer term, China's got really deep structural problems, really deep imbalances that it has to work through. And one way or another, it's going to work through these imbalances. And that almost certainly means that growth rates will continue to slow down pretty significantly. It was interesting because last night I had dinner with a couple of people, including a very a well-known economist who's a policy advisor to the government. And I can't mention his name because the dinner was off the record. But the big discussion was, we all know that the growth rate has to be much lower, but will the target next year be 4.5%? Or will they actually be willing to go all the way down to 4%? No one thinks they'll choose a target below that. But it gives you a sense of the way the discussions certainly among the economic policy advisors has evolved over the last couple of years.
Interesting. And your thoughts, Louis? You have your firm based in Hong Kong and other areas of China.
Yeah, no, first, it's a pleasure to be here. Thanks for having me. It's great to see Michael again. I think what's always fascinating about China, to Michael's point, is that the Western media, it's either feast or famine. It's always either China's taking over the world or China's about to implode and it's going to be a massive catastrophe. So you go from all white or all dark and sort of nothing in between. And there's no doubt that this summer we got a full dose with cover of The Economist, cover of Business Week, cover of Wall Street journals, like China's imploding, it's terrible, etc. Now, I think part of the reason for this China's imploding story is the remaining trauma of the 2008 crisis. I think people look at China and they see falling real estate prices, they see real estate developers going bust, and they hear that shadow banking companies are also imploding. And the gut reaction of everyone is, oh my God, I've seen this movie before. This is 2008 all over again. This is going to be a disaster. And they basically project their experiences from 2008 onto China today. But the financial system in China is obviously massively different than the financial system was in the US or Europe in 2008. So it's a parallel that's really a massive stretch. And so I agree with Michael that, the second half of this year, given the stimulus that's being put in, and given these very differences in the financial systems, the second half of this year might not be actually nearly as bad as the general media makes it look. But beyond that, for me, what's interesting is this whole focus on China all the time actually blinds people to a lot of good stories that are out there. And I don't want to take the conversation away from China, but the reality is for 20 or 25 years, all of us have learned to live in a world where growth either came from China or came from the US. And if you didn't have either, then you were in trouble. Today, what's fascinating to me is you're seeing soaring growth across Southeast Asia, soaring growth in Latin America, soaring growth in the Middle East, soaring growth in India, and nobody's talking about it. These markets are outperforming the U.S. markets on the bond side, on the equity side, on the currency side sometimes, and nobody cares, partly because we're all focused on China 100% of the time. And China does have issues, but it's also not imploding. It's slowing down for a number of reasons, but it's not going to be 2008 all over again.
Interesting. And your thoughts, Ira?
Well, this is certainly, in the realm in which I live in, and I have to follow this. And I read a lot of Dr. Pettis, of course, and Lewis, always a good read for me. But, when you talk to people on Wall Street, I think Luke Groman has it right. The rarest commodity on Wall Street is a history book. They know very little, and they follow very little. And, when I discuss with people, you have to take, and Hank Paulson has really done a very bad job because he clouds us up with the Wall Street mentality about this is what China has to do. But China, you get, and I want to hear Dr. Pettis talk about this, but it seems that Xi, who is not in power, so we go back to Hu Jintao and Zhu Ranji and those who were in, that if yes, it seems that Xi thinks that 2008 was a mistake, that ramping up, yes, it helped China for China to ramp up its economy in order to help ease the burden of the great financial crisis, but the amount of debt and extra capacity that was developed, it almost seems like Xi is willing to say, well, I think that was a mistake. Maybe we need to slow this down. So where certain people in the West are pushing, Xi says, oh, hold on a second. Let's see where we're going here. So I'm going to end there because that's the discussion that, I hear a lot take off, and I'm with two great experts here. So
comments on that, Michael, from what Ira has mentioned and observed?
I'm always a little hesitant to talk too much about the leaders directly, but it is interesting that in the last couple of months, you hear more conversations, obviously never publicly, but you hear more private conversations about whether the problems that China is facing began under Xi Jinping or they began under Hu Jintao. And I would argue that Xi Jinping has had to deal with significant problems. He hasn't dealt with them yet at all, but he's had to deal with significant problems that really emerged in the administration prior to his. And that was, the huge imbalances. Remember that way back in 2007, then Premier Wen Jiabao gave that very famous speech in which he acknowledged the deep imbalances in the Chinese economy. And he promised it would be the top priority of Beijing to rebalance the economy towards more domestic demand. And in fact, that didn't happen. In fact, for the next 5 years, the imbalances got much worse before they finally bottomed out and slowly started to improve until COVID, when they got worse again. So it's a really old problem. The interesting thing to me is the emergence of almost a consensus. It's not a consensus yet, but almost a consensus among economic policy advisors and economic policy makers, people around the PBOC and the Ministry of Finance, about what the sources of China's problems are. We're nowhere near implementing solutions, but at least, you know, that's been the big change in the last 3 to 4 years, a recognition that these imbalances have to be resolved, the debt has to be addressed, and the property sector had simply gone way too far and had to be restrained.
On this, sorry, do you mind if I butt in with a question to Michael? I mean, it's pretty clear, you know, under Hu Jintao, Wen Jiabao, it seemed like there was a lot of growth for growth's sake, right? There was a sort of the cult of the 8% number. There was the cult of the, you know, the GDP print, and that's by and large being removed under Xi Jinping, although not fully, as you mentioned yourself. There's still a debate. Oh, do we, you know, go all the way to 4% or all the way to 4.5%? So there's still a little bit of the cult of the GDP print. But do you think that is still there, or basically that's now being washed away and they're basically going to let GDP settle where it settles? Wasn't that the big lesson of COVID, that GDP settles where it settles?
Well, I think eventually we're going to move there, not necessarily because anybody wants to move there, but because we have no choice. I think the equilibrium growth rate in China is probably not much above 2 to 3%. And as long as they have GDP growth targets above that, there's no way to prevent the explosive growth in debt, which this is the year that I think everyone recognized that debt was out of control and had to be constrained. You know, to me, the problem is really a problem that someone like Albert Hirschman, who's one of my favorite economists, was writing about way back in the 1970s, and that is that a successful growth model, by definition, makes itself obsolete, because a successful growth model is the one that identifies your particular problems and resolves those problems. And once those problems are resolved, it's no longer a successful growth model. And what Hirschman argues is that, unfortunately, it's very hard to switch away. So as a result, you develop the opposite imbalances. And the longer you go on, the more you develop them. And remember, when China started the reform and opening up, it was among the most underinvested economies in the world, you know, for its level of social development. So what it really needed was a model that delivered investment, and that's what it got. The fastest investment growth rate in history, the highest investment share of GDP in history by far. But of course, that also meant that it closed the gap between the investment it had and the investment it needed. And I figured that happened sort of at the 2005, 2006, 2007, in that period there. And once that happened, continuing the growth model, as we saw with other countries that followed this model, Japan, Brazil in the 50s and 60s, the Soviet Union, debt started to grow much faster than GDP. And that's sort of been the case in China since 2006, 2007. So I think what's happened is that they're not eager to give up the growth target, because, as you know, that's sort of the organizing principle around local government. But I think they also recognize that it's impossible to maintain a GDP growth target without also implicitly accepting the soft budget constrained growth that Janos Corner wrote about and warned about, which in itself is the source of the explosive growth in debt. So I think it'll take at least 2 or 3 years before they give up GDP growth targets. But clearly they're preparing the way for giving it up. I don't think they've given it up yet.
Your thoughts, Ira, on the growth versus debt?
Well, I mean, I find this so fabulous. So, you know, that's the way I see Xi. You know, just from reading as much as I've read in my life and following this. And Xi is, first and foremost, it's a terrible label, but we'll say he's a Marxist-Leninist, and he will pursue that way and feels that he can probably go with a slower growth path and not, you know, everybody in the West thinks that, well, if China doesn't ramp up its debt restructuring, its spending, that the entire Chinese system is going to collapse. I highly doubt that. I think that China, listen, China, by any stretch of the imagination, since maybe a little bit before when we get done with Xiaoping, it's an absolute miracle for what's taken place there from where they were, from what do they call Mao's to whatever to Deng's pragmatism. And the shift is dramatic. The amount of people that they've lifted out of poverty, the people that they've lifted out of subsistence living has just been unbelievable. Can they take a breath? Yeah, I think that they can. And I think that's where Xi exists right now. We don't have to, we've got some latitude here to go as slow as we need to, not as fast as everybody else would like us to go. And I think that's and I think Dr. Pettis lays that out as Lewis does. I mean, now from an investment standpoint, how is this going to affect the way that we look at the investable world?
Isn't it? I mean, I may be wrong here, but it seems to me that, when China had these growth targets, 8%, 10%, whatever, you had 15, 20 million guys moving from the factories from the countryside to the cities every year. And so, if you didn't have high growth, you could have social instability. So you needed the growth to make sure that the guys got the jobs. Partly because of demographic shifts, but also partly because of geopolitical shifts, I think the number one goal of the leadership has now shifted to, it's no longer about creating jobs for everyone as much as it is about cushioning China's economy from potential U.S. attacks. And Ira, you and I have talked before about how, the attack on Huawei back in 2018 was really a game changer in the U.S.-China relationship. And I know we don't want to go too far down this rabbit hole, but the reality, I think, if you're China's leadership, is your concerns have shifted. It's no longer about growth for growth's sake as much as it is about achieving independence in a lot of key industries, whether semiconductors, whether frankly the whole technology ecosystem, but also energy, also and so while for 30 years you look to integrate yourself ever more in the global economy and you looked at that as a potential avenue for growth, today perhaps you're revisiting that entire strategy.
And further to that, Louis, do you see more of a change in China leadership for investing outside of China, like in the Yellow Crescent? For example, China's investments in Mexico and in Indonesia. Is that more of a trend that you see?
Yeah, no, I think my colleague Tom Miller actually wrote a piece about a year ago. He went around for 2 weeks around all the maquiladoras of Mexico, and he was surprised by how many of factories were now owned by Chinese entrepreneurs. And this reflects both, of course, the need to cushion yourself against possible U.S. sanctions. So, you produce in Mexico rather than China if you're a Chinese company. But it also reflects the fact that, Chinese workers aren't that cheap anymore. And that, for some stuff, well, definitely Vietnam will be cheaper, or Indonesia will be cheaper for all the low value added stuff. But at the high value added end of the spectrum, Mexico may actually be quite competitive as well. So no, you are seeing that, and to some extent, I think this is what's helping the boom across Southeast Asia, the boom in India, the boom across Latin America, is to a large extent, today China is allowing a lot of countries to industrialize on the cheap. And on credit. China comes in and sometimes builds infrastructure, or look, before you bought a Caterpillar machine, now you can buy a Long He machinery for 60% of the cost. Perhaps you couldn't afford the Caterpillar machine, but you can afford the Long He. I think where this is most visible now is in the auto industry. From nowhere 5 years ago, China is now the biggest car exporter in the world, and it's gotten there by selling to be honest, cheap cars, the sub 100,000 renminbi cars, so sort of sub 12,000 US dollar cars. And it's, you go to places like Chile, like Peru. I was there 3 weeks ago, and you see, you see a lot of Chinese cars now. So people who perhaps before couldn't afford cars, all of a sudden can afford a car because it's a cheaper made Chinese car. So I think China is helping a lot of emerging markets industrialize on credit and on the cheap. So if you're a Vietnam, if you're in Indonesia, if you're, Malaysia, etc., all this can be a game changer for you.
Do you see that trend also, Michael, in terms of China leadership and investment going abroad, in the Yellow Crescent or in the BRICS type countries?
I see it a little bit differently. I think for a while there was very rapid expansion of Chinese loans and direct investment into developing countries. But before I moved to China, I used to run trading and capital markets desks on various Wall Street firms specializing in Latin America. So it's an area that I know quite well. And I remember one of my students was, former students, was part of the group within the government responsible for lending into Latin America and into Africa. And I had many discussions with him. This was prior to 2016, when Chinese development lending was growing very quickly. And I told him, it seems to me that you're making a very similar mistake that other countries have made. You'll remember in the 1920s, it was when the US first really went out and invested abroad, particularly in Latin America. And we basically kicked the British out, and we thought it was because we were smarter. And the British said it was because we were mishandling risk. And in the 1930s, we discovered the British were right. Almost all of that lending failed to come back. You saw that with the Soviet Union in the 50s, with the Arab OPEC nations in the 70s, Japan in the 80s. It's sort of an old story. When you first go out, you tend to overestimate your ability to do it and perhaps underestimate the risks and the costs, because you typically go out during a period of rising commodity prices. And then you learn the hard way that lending to developing countries is not so easy. And I remember, discussing with my friend, your biggest loans are to Venezuela, Ecuador, Argentina. And I know from personal experience that investors are very nervous about lending to those countries, and probably for a reason. And I think 2015, 2016 was really a turning point, because you'll remember that's when Venezuela basically restructured all of its debt to China. And that came really as an enormous shock to people within China. And ever since then, you see that development lending, foreign financing, has gone down quite dramatically. It went down, it dropped during COVID, and then it popped up a little bit, but it's still way down from its peak. And I think that there is a growing awareness within Beijing that development lending is indeed quite risky. So I'm not sure we're going to see the kind of expansion people are talking about. And I also, and I'm sure everybody here agrees with me, that the whole debt trap diplomacy theory was a little bit, a little bit wild, a little bit out there. I don't think that's what was happening. I think what was happening in China is a very normal story. We've seen it before. But I think there's a lot more reluctance today to lend into developing countries.
Can I tag up onto that? I think indeed, like, as Michael said, when Xi Jinping gave his whole One Belt, One Road speeches and Silk Road Fund and all that stuff, there was, it seemed like there was a big green light given to all the banks, given to all the companies to go out and do things, whether in Laos or in Burma or in Kazakhstan or wherever else. If you could put it under the One Belt, One Road, then it would please Xi Jinping, and then that was good. So there was a ton of that done in the sort of, indeed, up till 17, 18. And then a lot of these things turned out bad. And so at the official, I think from the top down, there has indeed been, as Michael points out, a sort of realization that, hold on, let's take it easy here, because a lot of the money we've sprinkled around for 5 years, it doesn't seem to be going great. I think what you're now seeing is not so much from the top down, but from the bottom up. What you're seeing is you have a lot of Chinese companies that have moved up the value chain. You know, remember 5 years ago when Donald Trump was blasting China's massive trade surplus and saying the renminbi is undervalued and China's stealing our jobs. Back in 2017, 2018, China was running trade surpluses of roughly 30 billion a month, but China was not stealing our jobs. And when I say our, I mean Western world, because the reality is that China was producing, you know, cotton t-shirts and plastic toys, things that we don't really produce in the West anymore. So China was not really stealing our jobs. Fast forward to today, and China's trade surplus is now 75, 80 billion a month. And China is actually stealing our jobs now. You know, they've moved to number one as in the auto exporter. They basically own the whole solar panel industry. They're rapidly gaining massive market share in the earth moving equipment, in telecom switches. You name it, China's massively moved up the value chain in the past 5 years in industry after industry after industry. And this isn't so much, you know, the government planning it top down as bottom up. Companies like BYD, who can now produce a full scale electric car for $11,000 US. Sorry, the BYD Seagull is $11,000 US. And you're seeing these exports and the network corresponding. So now it's much more bottom up. Like I said, it's Chinese companies opening factories in Mexico. And they're not doing so because the government is telling them to do so. They're doing so because if you're a Chinese entrepreneur, you realize, you know what, for my own business, it's safer for my next factory to be in Mexico or my next factory to be in Vietnam than it is to build my next factory in Hangzhou or Nanjing. And so I think that's the shift you're now seeing in the sort of foreign Chinese investment. It's no longer top down; it's really bottom up.
Mm-hmm. Go ahead, Ira. Yeah.
And so now that Dr. Pettis has summed up my graduate school career, because I was able to read with Crawford Young and Charles Anderson back in the 70s at Madison, and God knows how much dependency theory I studied between Gunder Frank and, you know, so when you talk about that, I laugh because, yeah, I think China is trying to avoid a lot of those mistakes. First of all, it's a little bit different world, and they seem to be blanching a little bit and not, as the dependency theorists would talk about, you know, that the United States would just plow itself into not a colonial situation per se, but of course supporting the center of the periphery to do their bidding and produce what they needed to produce and direct that. And I think China is is learning a little bit, going, well, if we're going to compete, we're not going to compete in that way, because China's always had a much better relationship with Africa, going back, of course, to the 60s and 70s when they built the Tanzam Railroad, and they were trying to craft a more independent road. A road out. Now, yeah, I think they've made some mistakes with the Belt and Road Initiative, but do they want to act like an old line Western imperialist, or do they really want to promote growth in a much better fashion, which will, of course, aid and abet them anyway, because it opens up markets to them. And if we know one thing about China, they have a lot of capacity, because I think part of the problem of that 8%, 9%, 10% growth target is that they created a lot of capacity. And a lot of it was initially at the low end, but they've been pretty good, as Louis has pointed out, moving up the value chain. And nothing says it more than the cars. And when I look at the cars, I just had this discussion with somebody else, because they were talking about China, of course, now all the rave is the electric vehicle. But the Chinese they're more than that. And everybody talks about, well, if China implodes the currency. You know, I only look at the Chinese yuan now relative to the Japanese yen anyway, because to me, that's the critical factor. Because Louis pointed this out 18 months ago, Louis, whatever we talked about, that the Chinese were actually promoting a weaker yen because it helped remove some of the European elements out of the Chinese economy. And I think from the day you said that, it might be 2 years ago, it was definitely during COVID when we did a podcast, that to me is definitely been going on, and you're seeing it in Europe. Europe is getting priced out of China to me in a very big way, and the Europeans are screaming about it. But you watch that relationship between the yen yuan, and it sits here at between basically 19 and 20 and a half yen to yuan. And it's kept pretty tight, tighter than everything. And it's been sitting here. And this goes back, really to 30 years. It'll be 30 years January 1st when the Chinese devalued the yuan from 5.8 to 8.7 with the onset of NAFTA, and the yen yuan ran up to about 18 and a half as then the Japanese used a weaker yen. So this is a really important relationship. And as Louis points out, China is now the largest auto exporter in the world. And I look at the United States response to this. Here, classic case. The UAW is going out on strike. The big three have no chance with the yen this week because the yuan and yuan, I treat them as, they have no chance. The bargaining power of the UAW, somebody needs to go, hey, this is the wrong time for this. I understand their frustration, and I understand the need for wages to catch up in America, which have been hammered over 30 years. But this is not a good time for this. And a lot of it is just because of what Dr. Pettis and Louis talk about. And you're seeing it in the proof of the global auto market. And it's amazing that, and I'm not necessarily a cheerleader of Warren Buffett. Many things I disagree with him. It's amazing he found his way to BYD, right? And how successful this firm has been.
I'll add something to this real fast if I can, if it's okay. I think when we look at currencies, of course, we look at absolute levels, but I think it also makes sense to look at them in a purchasing parity basis. Because, I think today the perception is indeed the yen has devalued a lot, even the yuan, and therefore the renminbi should be next. But I think we have to keep in mind that over the past few years, China's basically had no inflation, when other countries in Europe, in the US, even in Japan, have had accelerating inflation. So if you look on a purchasing parity basis using inflation data, the renminbi is actually at a 10-year low right now, which perhaps helps explain why it has this 80 billion a month trade surplus, why China has this 80 billion a month trade surplus. The renminbi might look like it hasn't fallen a lot. The reality is it is today a very cheap currency. It is a currency that does not need to devalue. If anything, the renminbi should probably go up so that a country running a trade surplus of 80 billion a month is grotesque. If you add up the Chinese trade surplus at this point, it would be a G20 country GDP. Somebody like a Turkey, an Argentina, they have GDPs of 700, 800, 900 billion dollars. So China's trade surplus would be a G20 country in and of itself. So logically, what you should try to see is a stronger renminbi that would give more purchasing power to Chinese people and more domestic consumption in China. But so far you're not really seeing that. You're still seeing a managed renminbi that is, I think, too weak, that benefits Chinese exporters at the expense of Chinese consumers, and therefore, to some extent leaves growth perhaps somewhat imbalanced.
Your thoughts on that, Michael, for the trade balance in the currency?
I think one problem is that when we talk about the currency, we tend to look at renminbi dollar. And my understanding is that the PBOC looks at two very different measures. One is renminbi CFETs, which is the basket of currencies which it believes on a trade-weighted basis is the correct measure. We don't really know exactly what the division is, but I think dollars are about 20 to 30% of CFETs, and the rest is there's some euro, and the rest are Asian currencies. And if you look at the renminbi against CFETs, it's been pretty stable. So we saw a big decline from March of 2022 until the present. But that simply was the mirror of an extremely rapid rise in the year before March 2022. So you see against CFETs, it's sort of steady, a huge increase, a huge decrease, and we're back to where we were about 2.5 years ago. But they also look at renminbi dollar. And there, as everyone has pointed out, the renminbi, I wouldn't say the renminbi is at a 10-year low. I would say the dollar is really at a 10-year high relative to the renminbi, because it's mostly been dollar strength that explains the weakness in the renminbi, the apparent weakness. Now, which one matters to the PBOC? Unfortunately, it seems like they're stuck worrying about both. And as you know, it's very hard to have two targets, particularly when they're not correlated. They care about the CFETS basket because they care about the renminbi on a trade-weighted basis. And as Louis pointed out, and I think this is a really important point, a stronger renminbi is part of the rebalancing of income towards the household sector. And it's not just Louis and me who think that. It's not a theoretical thing. The former governor of the PBOC said that very, very clearly. He would like to see an appreciating renminbi, because that would transfer income from the manufacturing sector to the household sector. It would overall help rebalance demand. It's only one of many things that matter, but it's one of the things that matter. The problem is that most investors, and not just foreign investors, but wealthy Chinese, don't look at renminbi CFETs, they look at renminbi dollar. And when they see the renminbi weakening against the dollar, the big fear in the PBOC is you get a repeat of 2016, where a weaker currency encourages outflows, and outflows encourage a weaker currency. We're all emerging markets guys, so we all know that story pretty well. What the PBOC will do, it's really hard to say. They're trying to manage between both. We know that the PBOC would like to see the currency gradually strengthen against CFETs. They definitely have the firepower. They have 3.2 trillion in reserves. They have another 1 trillion in quote unquote hidden reserves with the state banks. The CIC has 1.5 trillion. So there's a lot of firepower there. But of course, you know, the currency is always a political issue. And so on the one hand, you have the PBOC who thinks a stronger currency is better for China because it rebalances demand towards consumption. And then you have the manufacturing sector, which thinks a weaker renminbi is better for China because it increases exports. And it seems to me that conflict has never really been resolved. We're constantly flipping one way or the other. But the PBOC has a really tough job because they've got to manage against both of these. And when the two separate, it becomes really difficult to know what to do.
Can I add something to this real fast? Because I think one fascinating development of the past 18 months, to add to Michael's point, is of course that, you know, if you think of China's trade-weighted currency exposure, and if you think, okay, you know, it's so much in US dollars and so much in yen and so much in won and so much in Indonesian rupiah, etc. The fascinating thing over the past 18 months is the chunk that goes to US dollar has decreased massively, because now, from out of nowhere, all of a sudden China is able to buy most of its commodities from Russia priced in renminbi, which I think is, you know, sort of a game changer in that equation. Before, China had no choice but to earn US dollars in order to buy the oil, the copper, the coal, whatever it needed to buy to fund its growth. And now, you know, following the kicking of Russia out of the US dollar system, all of a sudden Russia turns around and says, tell you what, I'll take your renminbi for my oil. I'll take your renminbi for my natural gas. I'll take your renminbi for my coal. And so, you know, with that, if you're China, the renminbi US dollar exchange rate starts mattering a whole lot less, right? Logically, it matters less. Now, you know, what could be the trigger for the PBOC to stop trying to ride two horses with one ass, if I dare say so? You know, try to like please the consumers and please the exporters at the same time. I think what could trigger a shift in PBOC policy is exactly what we saw in Europe in the 1970s. Because if you go back to the example of Europe in the 1970s, countries, or frankly Japan in the 1970s, Japan, Germany, they always try to keep the yen, the Deutschmark undervalued against the US dollar. And then oil prices shot up. And as oil prices shot up, basically policymakers in Japan and Germany had a choice. Either we keep the currency undervalued and we take the inflation hit and the economic hit of higher energy prices, or we allow our currency to go up and take some of the energy hit through the exchange rate. And that's what Japan did in the 70s. That's what Germany did in the 70s. That's what Switzerland did in the 70s. That's what any country that could afford to do this in the 70s. And I know we're not in the business of prediction, but I would imagine that if oil prices really continue to creep higher as they are doing, and we go past 100, past 150, that will be the catalyst that will lead to a revaluation of a lot of Asian currencies, not least of which the renminbi. They'll take the hit on the currency to absorb the economic shock of a higher oil price and allow their economy to basically sail through it.
Very interesting perspective with a historical context. Your thoughts, Ira?
I mean, this conversation is great. And I agree with Louis. And not only that, the Chinese are buying discounted oil, as the Indians are, from Russia. So as long as the Ukrainian, I've never understood the sanctions game anyway. I'm going back to 1959, and I could probably go very little. They seem to sell very good because it's done with numbers that you can make work. And I said it in real time when I saw Dalip Singh, who now is in private world but was in the Undersecretary of Treasury, laying out the sanctions against Russia. As I thought watching him, I thought I was watching Robert McNamara give, when I would sit and eat dinner with my family and we'd watch the press conference from the Defense Department during the Vietnam War. That's what I thought. It was all so nice and sanitary, and it's nothing of that. I think Janet Yellen can scream all she wants about the effectiveness of it. I don't think they're effective at all. And in fact, are delivering Russia a ready-made client, 2 ready-made clients, 3 ready-made clients. And even though India is now the proud sponsor of the G20 and is everybody's favorite because they're not China for the moment, India is busy buying as much discounted energy from the Russians as they possibly can, only to refine it and ship it then out around the world anyway. So they've been a terrible, terrible mistake, and it's playing right. And for everything that has been said here between Louis and Dr. Pettis, this is not going to end well. And if we go back to one of our first podcasts, maybe our first one that Louis and I did, which was in the middle of COVID. And during COVID, the renminbi actually rallied against everything. I think we went down to 6.20, which was quite a move. And everybody was looking for the other way because the global economy was slowing down. And China would, by its very nature, weaken their currency to make sure their exports. But it didn't go that way. So what did the Chinese do? They did exactly what Dr. Pettis said. They imported and stockpiled everything using a stronger currency. They stockpiled copper, they stockpiled steel, they stockpiled oil with a stronger currency. And then last year, when prices started to go up, they were selling off some of their stockpile to ease the burden on Chinese manufacturing. So I thought it was a very intelligent outcome. So they know how to play this game.
And Michael, just coming back a bit on speaking of history in the 1980s, there's been some observers comparing China like Japan. I know you've commented on this on your Twitter feed. Could you elaborate on that, on your thoughts? China like Japan of the 1980s?
Yeah, well, the point that I've been making, I don't know, like 10, 15 years ago, is that the Chinese growth model is not, this surprising, unexpected thing. We actually know quite a lot about this growth model. Probably 24 countries have followed it just since World War II. And it's a model which forces up domestic savings, basically by transferring income away from the household sector. And as you know, China did that to a greater extent than any other country. It has the lowest household share of GDP in history, the highest savings rate in history, the lowest consumption rate in history, though that's the same thing. And it channeled those savings into a controlled banking system, which then directed this capital very, very cheaply into a full range of investments. So it's a high savings, high investment model. And it's generated miracles in the past. For example, the first country to be called a miracle was, I think, was Brazil in the 50s and 60s. It followed this model very strongly. The Soviet Union, who gets some credit for having invented the model in the 1930s, the Soviet Union and Germany, was growing so quickly in the 50s and 60s that most intelligent people, from President Kennedy all the way down, knew that the Soviet Union would become the world's largest economy sometime in the 1980s. Paul Samuelson, in his 1961 textbook, figured that by 1984, it would become the world's largest economy. Japan followed this model. A number of countries have followed this model. And in every case, you've had that period of rapid, healthy growth, followed by rapid, very unhealthy growth with tremendous increases in debt, followed by a brutally difficult adjustment. And the interesting question then becomes, what kind of adjustment can we have in China? There are basically three ways China can adjust, right? One way is, you can call it the American way, the way we adjusted in the 1930s, very brutally, very rapidly, better for the long term, but terribly painful in the short term. And that's with a huge contraction in both GDP and household income. You'll remember in the 1930s, GDP in the first 3 years, GDP contracted by around 35% and household income by around half that. So the US rebalanced. The second way you can rebalance, which is, Brazil rebalanced that way in the 1980s with a terribly brutal contraction. The second way you can rebalance is the way Japan did. And Japan never saw that contraction in GDP. Instead, what happened is basically 0.5% GDP growth for 30 years, but household income grew faster than GDP. In the 1990s, household income was growing at around 2%, which is roughly in line with where it was in the US and higher than where it was in Europe. So Japan rebalanced that way. You could argue that's worse over the long term economically, but certainly it's much less politically and socially painful. And then the third way you can rebalance, and no country in history has ever done this, but it's at least theoretically possible, is to jack up the growth rate in consumption. So that GDP growth, which has to be below consumption growth, and investment growth has to be below GDP growth. That's the very definition of rebalancing. If you can get consumption to grow at around 7%, it was 4% before COVID, then in theory, you could get GDP to grow at 4% for the next 10, 15 years. Again, no one's ever done it, and it's politically very difficult to do because it would require, I figure, transfers of about 1.5% of GDP every year, probably from local governments to the household sector. But those are the ways you rebalance. There's really no other way. And so the interesting question is which is China's most likely rebalancing? Now, I think a crisis is incredibly unlikely in China, not because they can manage crises well, but simply because a crisis is a balance sheet problem. It's a mismatched balance sheet. And in China, although if you look at the balance sheets, they're horribly mismatched, in practice, the regulators can restructure liabilities whenever they want. They've done so every time there's been a problem in the banking system. And as long as they're credible, and they're very credible, they'll continue doing so. So that's why I think most people are sort of now agree that we're much more likely to see a Japanese style adjustment than we are likely to see a crisis. But, we'll still see. The jury's out.
Great points and insight. And just coming to a time closure here, Louis, given all of this discussion, what are your investment ideas or potential investment asset class portfolio?
Yeah, look, I think at this point, a lot of what's going on in China is sort of a distraction to a large extent. I'm not saying it's not important, but it seems to me that there's actually bigger stories out there. I think to Michael's point, there isn't going to be a crisis in China, and either we have some policy choices that are made and we end up with a good outcome, or we have a slow long bleed. And right now it seems that the policy settings are directing us towards a slow long bleed. And frankly, it's not obvious to me, like, what's the trade, right? You could say, well, you short iron ore. Well, iron ore is up 50% since China reopened on October 31st. Or you short LVMH, but LVMH is close to all-time highs. You buy long U.S. Treasuries because China's going to be deflationary for the world. Well, that's been a horrible trade. U.S. Treasuries go down every day. So for all the talk, and I always ask this to our clients, it's like, okay, I'm very happy to talk about China all day, but like deep down, what do you think the trade is? You could say, well, let's short Chinese stocks. I think that's not a great idea because you now have a government that clearly is trying to goose up the Chinese stock market, and the Chinese stock market isn't very expensive to begin with. So for me, it's almost like it's a little bit too much of a sideshow. I think for me, the biggest stories out there is that we've started an epic bull market across non-China emerging markets, and most people are missing it. Whether you look at India, whether you look at Brazil, whether you look at Chile, Mexico, Indonesia, Argentina, all these markets, the currencies are going up, the bond markets are going up, the equities are going up, and nobody seems to care. Which is great. You got positive momentum, attractive valuations, and complete disregard from anybody out there. So I think there's still a long way to go. I think for me, the other big themes out there is that, Western currencies, whether you look at your yen, your euro, your sterling, your dollar, they're all being debased rapidly. Fiscal policies are basically on an unsustainable path in most of the Western countries. And you're seeing bonds sell off almost daily now. For me, the big story of the summer is not really so much China as the fact that against the growth that was rolling over in the U.S. and inflation data that seemed like it was rolling over, against all signs of a recession in Germany, German bund yields are going up every day. U.S. Treasury yields are going up every day. That to me is by far a bigger story than what's happening in China. And I think the third big theme, if one big theme out there is the EM bull market and the other is the Western currency debasement, the third is we've spent a decade under investing in energy. And Ira and I have talked about this in the past, but energy prices are now, grinding up daily. And our ability to control energy prices is now much more constrained by the fact that the SPR is almost empty, or at least it's at a low not seen since 1986. So we're coming into an election year with energy prices grinding up, which is never a good thing. It's never a good thing if you're an incumbent. So whether you're an incumbent in Britain, whether you're an incumbent in the US, you hate seeing energy prices move up. That's when you get political rebellions. So for me, those are the three big themes. China at this stage, it's a bit of a sideshow. And yet what fascinates me is that's all you get all day, every day on financial media, when it's by far like not at all the biggest story out there.
Great. And how can our listeners, viewers learn more about your work, Louis?
Oh, they can go to our website, gavekal.com, Gavekal. We do lots of different things, but yeah, you can find it all out on the website.
Cool. And Ira, your final thoughts, and how can our listeners learn more about
this is, doing these podcasts is just great. I mean, I'm sitting here learning and being able to discuss and hear Dr. Pettis discuss and Louis in real time is what it's just unbelievable. And this, and I think, Dr. Pettis and I, when we did podcast last time, we didn't discuss necessarily the investment view as much as we did, I think, geopolitical economy and what looks interesting. But Louis and I have discussed, I go back and I review when I think Louis and I it was a little over 2 years ago that we did our first ones. And I think about the things we talked about, Freeport McMoran, Bunge, Glencore, and banks. Louis, like DBS, I'm still very bullish on Mitsubishi. I think the Japanese are sitting in a very enviable position for the first time in ages. They don't have the same risk that Western banks have because the bonds that they have on their books are not nearly as overvalued and are suffering losses, unless they hold to maturity. But we found out how that doesn't work in Silicon Valley and First Republic. So there's a lot of issues out there. I think Asia, to me, as both Dr. Pettis and Louis have talked about, are a much more interesting story. And, the world gets, especially Wall Street, they approach the world with very static lenses. The world's not waiting for the US anymore. They're not going to wait. And everybody's on the move trying to figure this out. I mean, you saw this at the G20 and you saw it at the BRICS conference. I hate that phrase, but okay. People are moving and trying to ascertain where they belong in this. I mean, we got Lula back in Brazil, and Lula has a very good global perspective. He's done a lot. You can disagree with things that may go on domestically in Brazil, but Brazil knows its role, and the fact that it's now superseded the U.S. as the grain market for China is no small thing. And we see that because grain prices continue to hold, even as we've brought in, this year we won't bring in a record harvest, but between the U.S. and Brazil for 4 or 5 years running, we had record harvests. So there's just so much movement. And so I'm still looking at these scenarios. But the one thing that has changed is that global capital is a hell of a lot more expensive. And as I discussed with Doomberg and Dr. Alaji and Adam Rosenweig, that everybody talks about the green movement, but the cost of financing the green movement is becoming more expensive each day as interest rates rise. And even the global South, our new phrase, we've gone from less developed to emerging market, we're now the global South, they want the developed world to finance and pay for almost like reparations for the real movement away from carbon into the atmosphere. So that's going to be a very interesting discussion going on. And nobody's positioned better than China, by the way, especially with their role in the battery market. So a lot of things facing us.
Great. And Ira's blog is iragharris.com. And your final thoughts, Michael, and also how our listeners, viewers can learn more about your work?
No surprise. I agree with Louis and Ira. I think I have a piece that just came out in the World Politics Review, which argues, similar to Louis, that the slowdown in China, which is obsessing people, will probably have a much smaller and a much different impact on the rest of the world than most of us assume. So I think, it's not that China doesn't matter, because its impact will be really unevenly distributed, but it's going to be mildly positive rather than a huge negative for the world. I publish a lot of stuff on Twitter. I'm part of the Carnegie China, so I have China financial markets on the Carnegie Endowment website. And then I do a lot of stuff in places like the Financial Times, Foreign Affairs, etc. I write a lot. I don't recommend that people read everything I
write. I'm going to say I read most of it. I read Foreign Affairs, and I always find them in the Financial Times. But I've read The Great Rebalancing, so I've read several of your books. So thank you for taking the time and providing us with as much wisdom as you do. Thank you.
Yeah, awesome, insightful discussion. Thank you so much, Michael, Louis, and Ira. Thank you.
Great to see you.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.